Greetings, market rebels. Welcome to this week's macro measure combined with sector situation due to it being Sunday, December 24th, 2023, which is also Christmas Eve. So things are in motion here, and wish everyone a Merry Christmas if you celebrate it, and Happy Holidays if you celebrate other things, and Happy New Year if you take a break and don't get started in trading until the new year, which I couldn't blame you. We'll see. As always, we get to see what's up with the market this week. But I'm Wayne. It's I guess around 9:30 a.m. here on the on Sunday on the East Coast, and so I think that's the typical stuff that I try to share. In other words, that way you know what news I may have been able to come across by the time this gets recorded. Trusty disclaimer from Market Rebellion here, and trusty intellectual property rights notice. And then this is really a pared down sort of different approach, just because I felt like shaking it up a little bit. And I think this is a good time. It's kind of customary. I'm not sure if we're going to do an end of the year or start of the new year discussion. I thought we were. I'm not sure. I haven't heard any updates on the timing, which I guess I may have gotten wrong. Anyway, I'll leave this up there for just another second or two, just kind of visual reminders. But yeah, there's so much. I may go back to last week and see before we close out if I may go back to that and say, okay, what should we do here? Let's make sure we mention this and that as part of it. But more than likely, I'll just try to stick with mostly this stuff. But what I would say first off is, the theme of the week is I see the upside, but I see the downside too. And I'm going to try to show quite a few tabs. So given that I'm combining things, I've spent quite a bit of time trying to put this together. Not nearly as much as I would have liked, but it is what it is. And I would say set your playback speed to 2 times, because it's going to probably take a little while. On the other flip side of that, if you want to fall asleep, leave it at 1, and you probably will. But hopefully not too many of you will fall asleep. So I'm going to just start out right here while we're here. Short-term take is, to me, the market does look exhausted and dangerous as a result, because I do see some issues that cropped up, right? But that's at the same time, last week was really more of another pause, and they held, and you haven't cracked any trends, right? Even in the short term, in any way, really, that I can see with the major index ETFs. So knowing that, and knowing what the gang normally does, which is the gas pedal this thing all the way into the new year, and they'll be getting their Santa help, in theory, at least as per CNBC drum beats, really, right, coming up on Tuesday. They're only 4 sessions away from achieving the max markup goal that they probably initiated at the end of October. So in my big picture take, the more information I come across is that we're really in some incredible times. To me, this is definitely not the market I grew up in. It's not the market I first got started trading on the floor in. It's none of that, and it's a lot of things. To me, like, it just seems very, very different. Like much like the late 90s were, where it just felt a lot different than the earlier 90s. It's almost like leaving one era and moving to another era or mini era. So the markets are, to me, are just, it looks amazing and dangerous at the same time. So again, that's why I'm hitting on, I see the upside, but I see the downside too. So it doesn't get easy for us. That's part of the allure, though, of being an active investor or an active trader, because it's something that's usually pretty interesting. And so it keeps you engaged and keeps your wheels turning, which is good. So I would say the Mag 7 are on the verge. I really thought they were going to try to do more with them, but I guess they haven't been able to really pull it off yet. They've been getting hit overall with a dose of negative news. I do think that the major indexes are on the verge as well of trying to go. In other words, they're all set up to go. The biggest problems are, you always have the false breakout issue, and anytime you're potentially breaking above new all-time highs, there could be the initial pullback, sort of trap everyone that got long, have a little swift pullback that's kind of nasty, get a bunch of people flushed out, then try again. Who knows exactly what will happen, but that's the thing I always think of as soon as I'm near resistance that's been stout and just, it's just something you have to worry about. On every breakout, it could be a false one. As I mentioned, negative divergences are cropping up. Also, I would say that it's just very difficult right now because you've got probably in normal times, right? Like normal trading weeks and months that are not really this part of the calendar with all that's going on right now. You probably would say, look, I think there's at least like 2 to 3% pullback that needs to happen. That probably would happen in most cases, but that is really right. That is really not something that we've seen along the way since they started to jam things. And so that we'll see right from our information we're about to share that they normally just jam this thing in the last week. That's pretty much it. So you have the tendencies that are strong versus very overdone conditions. So that's why I think it's a difficult time. In the end, I would say, you've got to trade what's in front of you. So as long as you're holding support, as long as support isn't cracked, then I would stick with it, just because that's the trend and that's what they typically do at this time of the year. So I would say that if they don't get major news, then they pretty much dodge a bullet right this week because all they really need are 4 sessions after Christmas, and they can 4 solid sessions that are even just a pause is a big win. A slight push higher is even another win, whatever you want to call it, but that's all they really need. So I can't imagine them being this close to the finish line and letting the whole house of cards that they've constructed fall apart. But it could. We'll see. I do want to reiterate that there's the inflation catch-up potential. I think I have a tab on that. Excuse me. And all I'm really getting at there is that if this market is, excuse me, so the Q is making a new nominal high, but the market really hasn't made a new high if you adjust for inflation. So there's almost 10%, I think, from what I've uncovered in some people's takes. I don't have time to crunch all that data myself, but that you're 10% undervalued relative to prior highs due to inflation. Whatever the case may be, there's potential there. Even if you break out some new nominal all-time highs to make a real new all-time high, you could really have to get up there. But that also says, like, if people really do believe that things are getting back on track, that there's almost a 10% discount. To me, I thought the market was mispriced when it was at the top. So Ryan and I were, saying like, I think what's going on here, given what rates we're about to do. That was, I think, at the end of 21, I want to say. Yeah, I think it was the end of 21. But now, right now, I would still say that there's more potential. I do think in the first quarter, I would expect them to do well based on, again, save for a new major news dynamic shift. Uh, I would say that there's probably a good chance they try to keep things where they are in the first quarter. That's kind of, I think, from what I've heard, against the Tom Lee take. He's looking more back half. I don't really have the data, unfortunately, that those folks do. I'm looking at it more from what typically happens in the winter time. It's really November through April are your best. It's your best 6 months, I believe. So, or maybe it's Oct through March. Whatever the case may be, we're really more in it. And this year is the year where it typically is the second best year of the cycle. The difference between when we were bearish and thinking the market was mispriced is that, and now is that, rates have really risen dramatically, and they're apparently, according to the bond market, it seems in a lot of expectations, they're about to head down, and they look like they're on the verge of cracking the uptrend. So as of now, to me, so I think there's, that's why there's potential here, and I'm looking at it differently. But I do think there's a risk that it all looks as though that will happen, and maybe it starts to happen, but then maybe inflation somehow roars back or news developments occur. The consumer somehow continues to deteriorate, and then that story sort of falls apart. I'm thinking in the spring, but this is all, it's all pure just conjecture just from thinking about it. It's not anything that's I could prove, with geometric logic. It's really just my take on it. Anyway, remember the AI hype momentum. I would say buy the hype, sell the tulip bulbs on this stuff. So I do think if they manage to keep that kind of hype or reinvigorate that hype, you also probably go. And again, if you're still really early stage hype or even middle stage hype, there's still tulip bulb time, maybe that comes from that. And I just don't think you can rule that out because the financial conditions have eased from what I can tell. The financial conditions, contrary to what my intuition would suggest, maybe yours would suggest, it looks like they have honestly played this game where somehow their financial conditions are easy, and yet rates are up there. So it's sort of contradictory, but it's always tough to figure out exactly what's going on, which is why economists have such a hard time, and historically had such a hard time. The other little note would be that I'm not a big E-wave guy, Elliott wave guy. I had to use it. You had to be a part of that for chartered market technicians. I looked at it in depth, worked with it some over the years, and especially a long time ago. But to me, right, it's I'm not saying it doesn't work. If it works for folks, great. But for me, like it's not as practical in terms of being quick thinking and being quick to act. I think for me at least, this other technical analysis is easier to apply and get a sense of where you are in a more simple way. And in other words, it's just more practical in the heat when you're under the pressure of actual trading, minute by minute or minute by minute or hour by hour and day by day and week by week. So and I think that really is a great fit for position traders, but that are longer term oriented. But for me, right, working in the kind of here and now, it's something I kind of abandoned a long time ago. But anyway, I'm not discounting that it doesn't work. It just, for me, a lot of people, I think BMC would argue that it doesn't work. But what I would say is there's a lot of talk that I've seen out there in terms of where we're hitting a wave 5 of 5, which means like this upside move that's been in place for many, many years, decades, in some people's view, terminates, and we go into a really serious situation. But at the same time, right, they may be right, but that's also helping the wall of worry because a lot of people do uh, do like that approach. They do buy into it. I think it's very difficult to apply, like I said, in kind of like in a very quick, pragmatic way. And there's always a lot of adjustments that I found myself making. And even experts really can disagree on exactly what the wave count is and where we are in the grand scheme. So for me, it's tough. But anyway, that's just something I thought was worth sharing. So there's a lot of that out there. I think some of the points that some of these folks are making are well founded in light of all that's out there too, sort of like societally, excuse me, or sociologically. That would be more like a Prechter thing, which is what he's known for, and other guys. But at the same time, I would say, look, they may be right, and you have to kind of have it in the back of your mind that this could fall apart in a big way. Maybe just because there's a lot of there's a lack. Well, the other way we could say it is there's a lack of authenticity to a lot of the reports that come out, and maybe there's exposure there somehow. Don't know, but anyway, hopefully you understand what I'm getting at. But that does add to my sense that something's lurking. I just have this feel that with some of these reports I see that the Fed had to do this, the Fed had to do that, they're bailing out this. There just seems to be issues out there that aren't being covered that are in the financial system, and that's usually where these big sort of dislocations that follow really emanate from or originate from. So anytime there's some systemic problem in the banking financial system, that always gets my attention just because that's been the source of so many problems over the decades that I've been involved in the market, on a day-to-day basis as a professional trader. Anyway, stellar technical qualities are there. It doesn't get much better. So that's again the sort of duality paradoxical thing where you've got a great looking situation, doesn't get much better, and then you have to remember it doesn't get much better, right? So it does that usually it means, right, you start to see a few issues arise in the technicals, but the breadth has been super wide. The breadth has been deep. The sector participation has been excellent, save for a few. Those key sectors I note there, they have participated strongly. I think those are the ones that sort of show you what's happening overall. But most sectors have been a part of it too. So I will go through the tabs check, which is pretty extensive this week. You'll see why. And I would just reiterate that money supply matters a great deal, and the money supply depends on who you want to listen to. But some folks are, some folks are correlating the money supply that's out there with equity prices, which has been largely true in my mind over the course of time. And that's the issue. There's just a lot of money sloshing around out there that makes it possible for folks to just keep dumping a lot of that into equities. And I'm taking that rate cut story seriously this time. I'm not fully convinced of it because I do think there's still a possibility that inflation could crop back up a little bit. There's sort of like this little echo thing that from what I've seen happens historically where everyone thinks it's over and it's not, sort of comes back. I'm not saying that will, I'm just saying it's a possibility. And that's what keeps me sort of concerned about that in the sense that I'm not really ready with full buy-in, but I am taking it very seriously. I didn't really take it seriously or give it much weight or credence in, well, maybe it was the winter, early spring of 23, earlier this year. I didn't think that was really in line with what was happening, and I think it turned out that it wasn't. But it's because the bond market seems to be taking it. I am too. I'm taking it seriously. I am too. And then finally, I would say, look, for everyone wants sort of the, excuse me, the forward-looking stuff and predictions, which again, I would say are not really your friend. They're sort of a deceptive friend that can really get you hurt, in my opinion. But that's what people like. That's been the tradition, the convention of really charting, technical analysis. But I would just say, sort of in relation to that, what I would look at maybe, right, if there is going to be this bull market that really extends, I think you have to look at IWM because I think if rates are going down and we're really about to bounce back, right, that's probably undervalued technically speaking versus the other indices. XLE, that's certainly lagged. That's probably the last big sector that we need to participate to have it appear as though the market is super healthy in terms of what industries and sectors, right, are really doing well. Financials and transports to me are important, but semis and the big tech are too. But lately we've had, the industrials came roaring back, so did consumer discretionary. So with that in mind, if they get especially, XLE, I think they've got everything clicking, and that it's sort of been slowly improving there technically, and yet it just hasn't gone yet. So it's at least trying. It's not getting smoked, right? Other thing would be commodities, and then I think the gold and the junior miners. So the Mag 7, of course, I think you'd obviously have to keep your eyes on, just as a mention there. So that covers all that with a few additional comments. What I'd like to try to do now is let's see if I can reposition things briefly. I will stop the share and then we will get out of PowerPoint here. And I'll get over to here. I don't want that. I want this over here. And then I'll just have to bring that up if I have to. And now we can move into the first part of let me get the first part of the tabs check going for us. We'll do we'll do the usual suspects first in terms of our quick tabs check, but then the second part of this tabs check is what I've been really working on and want to share with everyone more so. I'm kind of eager to share some of this stuff because I think, again, I hope that what I can do is help folks to avoid getting too allowing really a lot of talk and chatter to keep them from doing as well as they can in the markets with the type of movement that's been available to us. It's really been some great price action, I think, over the course of the last 2 years, but you've had to be willing to go in really both directions at times, and so to really capitalize on it all. But here's the 10-year, and for some reason I don't know why, but it's really not letting me draw anything here on it, which would be nice and convenient, but it's possibly right getting there where it could crack this uptrend. And so if that were to happen, right, that's rates just keep coming down. That's really great in the longer term, but over the next year, which we have the tab on, you'll see that, right, it's really not that great over the next year once they start cutting. However, it looks as though, according to, right, the market, we're looking at a really great chance that we start cutting quickly, right? So January might be high probability we sit still, but the cuts start in March according to the market, and then you're down from there. So with that in mind, right now, of course, a lot of people see this. They think, oh, wonderful, rates are on the way down. Low rates have been really, right, the tonic ever since. I think they were kept artificially low in the 90s by Greenspan, but they've been really the tonic since the QE madness started in 2009. So for the last decade plus, it's been such a big thing. Sentiment, right, highest level in over 2.5 years. So if you want to be concerned about your risk, knowing how contrarian this tends to be, at some points, then you've got to be on guard, right? So this is part of the whole picture to me right now. If we go back just one, we should see that here you are at 52.9, highest level in 2.5 years. And this bumped a little bit, maybe because things are getting overdone. But you were only last week, I think you were at a real serious low in terms of bears that are out there, which you'd expect. The imperfect CNN fear and greed did reach extreme greed at this point. So another kind of little concerning issue. As far as our check at market rebellion on some of the percentage of stocks above certain simple moving averages, here's the 20-day. You can see over the course of time, I put a lot of time in here, but you are up there. So I'm not a stickler for, well, you better exceed that high or it doesn't really matter. You're there, right? You're close enough. And that's, to me, what you have to be on guard for right now. The same is true with the MMFI, right? So the percentage of stocks above the 50, it's the highest in really a couple of years, maybe several years. So, again, if you're really waiting for, no, this thing has to get even more torqued up. Maybe it will. I don't think it has to, though. It's close enough to where you ought to be a little concerned about downside and not allow them to lull you into a false sense of security. Don't get complacent. In other words, even during a holiday week, which could be thin trading as the week wears on, and that could create possible shenanigans to the downside. It's not normal, right? It's not what we would expect, but these are the market conditions that make stuff like that more possible. It would be shocking to me in some ways that if the gang let this market go down 5% that fast, something like that, in a real swift sell-off, when they were so close to complete victory, 4 sessions away. But I have seen it happen. It does happen. That's why in the market, you can look at tendencies, historical, this, that, and the other thing. And I do, and we do, right? But the reality is it doesn't have to happen that way. So this is the reminder of where we are. The quick reminder is, look, we've been saying this. We've shown other graphics. The gang gooses into year end, right? It almost doesn't matter what year you're in. Pre-election year tends to be really good, which is what we're in now, excuse me. But otherwise, it's really good. And then what comes next year in election year is you get out of the box, you kind of have this little kind of push. Typically, right, that little push fades. They get it back on track. They kind of rally it from there. Really, it looks like maybe into the second half of the summer, which you'd kind of expect. That's what I've been mentioning, where they make, just like they did this year, they make everything look wonderful right after the second quarter earnings are released and covered in July and August. And so we'll see. The next one is, here's your seasonal patterns. This is from the Almanac Trader. So this is the seasonal pattern. You can see the seasonal patterns in December, especially late December. So that's why it would be irregular, right? If we did get something like what we just talked about in terms of a really swift, nasty sell-off. I'm sort of not expecting it, but remember, news can change anything. This is a guy that Nick Mangioli. This is a Forbes article. He was at Ritholtz Wealth Management. I guess when he performed this, may still be there for all I know. Anyway, this graphic we've been sharing because everyone's getting excited. The swimming pool's getting full. Everyone's getting on one side of the boat, or in the process of maybe most people being on one side of the boat, and they think everything's going to be wonderful, and it very well may be. But what the evidence shows, according to Nick, is that you get this performance. You've all seen this if you watch the videos each week. So basically a year later, the market's down somewhat, right, significantly. So just keep that in mind. Now, on that note, what I would like to do, if it lets me just briefly stop the share, make sure I can get the right stuff over here. And I do actually have it for a change, so I didn't need to stop the share, but usually something gets fouled up. So I wanted to cover these tabs here, excuse me, because if we don't do an end of year, if we don't do an end of year or beginning of the new year program, I figured I would weave this in, and at least folks that watch the videos maybe could get some benefit from it. So again, just wanted to let you know, right, how swift this move has been. So this isn't like a tweet from yesterday, but it's a tweet really from, a little bit more than a week ago. And you could see that it is, this is one of them. I mean, you got to get over to, it looks like about 2014 to get something that's been more swift. So this is, remember, these were kind of crazy times here too during 2008, 2009. So this is what we just went through, right? So this is, if you've done really well, great, but just be very careful. The other thing I wanted to note about this one is that hedge funds are now doing what hedge funds appear to want to do, and they're just not on board with oil rallying, or as we would discuss it, right, XLE heading up. So that's also potentially a nice little thing to keep in mind in terms of what we're thinking about for next year. Here's the one I'm talking about, right? Financial conditions have eased, and that set the market soaring. Look at financial conditions here. So I can't vouch for this. This is not my data, but I'm not going to even be able to get it for you clearly. But this is it. I mean, this is coming from macrovisor.com. So yeah, so there you have it. I mean, if you're wondering where things are, look where they are. I don't have the scale here, unfortunately, but if this is the last 2 months, then this goes back, it looks like, until last year maybe. So there's eased as they've been at any time over the past maybe 18 months, ballparking it, can't really say. This is the number of stocks, right, trading above their 50-day moving average, according to this tweet. This one, obviously, right up there. We know what happened after the meat and potatoes of Q2 EPS were reported by the end of July, and that was that the market got whacked, right? So just keep that in mind, because I think there could be a hangover. If they get through this week, I think there could be a hangover effect. Here's another look at this from this guy, Jay Keppel or Capel. I like the stuff that he puts out. I've seen really interesting stuff. He's got, really, I guess, extensive or access to extensive data. But yeah, anyway, this is what's going on here in terms of breadth. So SPY is higher. When you see this, right, SPY is higher 98% of the time, 12 months later, with a median gain of 13.8. So you can see that there's compelling stuff historically, right, that says, no, we just keep going. And that's what next year calls for in terms of the typical cycle. But at the same time, right, you see that when they start cutting rates, things get smacked by about the same amount to the downside. So we will see. We will see. Here is right? Even the S&P hasn't made a new high. It's not even, I don't think, a new nominal high in the SPY, or SPX. I'm not positive on that, but you get the idea, right? And so it's been a while, like since in other words, we've been away from an all-time high for a little while here. And this is one of your longer stretches. You've only got a few that are worse than this, and that's really after the dot-com absurdity, insanity, whatever you want to call it. And then, of course, after the latest banking crisis that no one saw coming, including the head of the Fed, who said it was contained. And this is it. This is it. So this is another one where I just thought it would be worth showing that, we've been saying that the breadth has been very good. I mean, I don't know where people are coming up. There was a point at which the Magnificent Seven were driving it, but they haven't of late. I mean, it's been other things. In fact, they've been a little disappointing in some ways. They're maybe our leaders though, and they're resting, getting ready to make another run. We could say, who knows? But the bottom line is that, yeah, there's a lot of other things participating. I'm not sure why that's still out there. I don't think that's a really legit argument. I don't think the breadth has not been narrow, in my opinion, anyway. I guess maybe you could see it a different way, but I don't see it. This is the second highest level of the year, right? In terms of 200-day average hit 75. So there's 75% of stocks that are trading above their 200 at this point now. And so remember where that, right? This is sort of interesting, right? The times of the year where we've gotten here and what happened subsequent to that. So just be careful. Percent, and it's kind of another look at a percentage of stocks at new 52-week highs confirms rally, right? So this is breaking out. So this is really, how can you say it isn't? I don't know how you can really say unless you're waiting for the highest high. But the point is, a lot of these types of technical things that guys like me, but guys that have a lot more time and access to information, which would be awesome, that delve into this stuff, that do a good job. These guys do a really good job that, we share from what I've seen. This really is convincing that a lot of these technical things under the surface are convincing people that have a technical weighting that things are awesome. And here's another one, right? This is oh no, okay, yeah, this is the one. So that was a repeat, my bad. That was shared by another. We don't need that one. That was shared by another person. The other thing, though, this is a little concerning, right? This is the dumb money confidence, and look where it's gotten to, right? So right before the smashing there, right? I guess when COVID hit, another one that did virtually nothing. There was a 3-month pullback when we got here, way back when in 2010. Another 3-month pullback. So not enough in terms of the number of occurrences, but you're getting up there, just another factor, right? And that's probably contrarian historically, but I don't know about recent times, unfortunately. And what another sort of related item would be that U.S. call volumes are hitting records, right? So, which we love because we're options folks, but there's tremendous liquidity and blah 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 out there. But it also is potentially contrarian as well. This is the kind of money that's coming in. It's the biggest 5-day influx, according to Jim Bianco, since 2018. You had Volmageddon following the week. You had Volmageddon and things went haywire, right? So the VIX went from 12 to 53 days. So again, another thing where for every great bullish thing out there, there's some bearish stuff too. Here's, according to Mike Zaccardi, this one, there you go. Another, just look at that. Look at the surge of capital. And that sort of kind of coincides with that easy kind of financial conditions being super easy despite all the headlines or what they're trying to sell you. Excuse me. So the 7th consecutive positive week got put in. Right, this is really the outcome of that. So 20 of 30 times you were up at least 7% from that point. So The 1% moves up, we're 14 to 1 over the next 4 weeks. So that would be right into mid-Jan. So you're up, so basically you don't go down. That's why I'm saying, and this is not an easy time. This is that inflation number I was getting at earlier that Michael Guy had shared, that I think I mentioned the last week or two, because I was thinking it myself and looking around to see if anyone put something out, and then he did. And there you go. I mean, you've got this discount, if you will, to where things could be if you adjusted for inflation. Yet you also have the longest ever yield curve inversion, right? So don't even know what to say here. It doesn't seem it doesn't seem like a good thing, but so far, right, the market isn't really reacting to it or seeming to care about that. So we will see what happens. Anyway, this is another example in terms of, if you look at the money supply, which some people would say money supply growth, some people are saying no, this is contracting. So there's a lot of conflicting stuff out there on it. But if you go with the financial conditions being easy, I would kind of lean towards, well, there's got to be a little credence to what's being the argument being made here. And really, what happens is that um, you tend to get inflation, um, essentially, right? And I think it's just monetary inflation just keeps these, not really inflation, but monetary inflation, I think is what they mean, is what helps to take things up and up. And maybe it's all about that. And so if things really are easy right now and people are going bonkers, right? There's a lot of money flowing into this. And there seems to be a relationship between higher equity prices and a lot of money sloshing around. So in that way, it makes sense. The reminder is, though, that right, it depends on how you want to look at it, but this is pretty costly. Just this is what part of what I think fuels these higher prices now is what these guys continue to do with our purchasing power. So if you're not an asset holder, life just keeps becoming more and more of a struggle for you because you're not getting to offset the costs of all the stuff you need to purchase or you do purchase. Your investments aren't outpacing that if you're not in investments, right? So it's hurting, the majority of people that are not well off in this country, which is just criminal, but it is what it is. Just another person saying keep an eye on the XLE, the energy sector, whatever you want to call it. This is from Morgan Stanley, but put out by the Markets and Mayhem folks. Basically, that is what we've been talking about in terms of the technicals slightly improving. This is the argument, in terms of commodities. There seems to be an opportunity there where commodities are just dramatically undervalued. So again, I think that's true. I'd keep your eyes on that. There is concentration, though, in terms of the Mag 7. So even though the things look pretty good for the Mag 7 and have been pretty good, this is the highest level of concentration since when. So you got to go back a few decades, but I do go back a few decades, and I remember this whole situation, and it was amazing. And it is what it is. So just keep that in mind because it's not normal that you're this high. This is another sort of, I think it's point and figure based approach that's been out there, and you could see, right, that you're really overbought in terms of this BPI measure. So I think Ryan did share this in a few webinars this week. You would This is, if you look where this typically appears, there's usually right corrective action that follows. So again, if this starts to get rocked, you've got to be ready for that. Okay. You got to be ready for that we could start getting rocked anytime, really, obviously. But I'm thinking it could happen in the new year out of the gates. And then they start using that correction to, of course, to add and still believe everything's going to be super. This is got to be concerning, right? Considering how much of a part of the landscape in this economy that housing's become. But I don't know if it is adjusted for this, though. That's the problem. I don't know if if they really are building smaller homes So less square footage, lower prices, and that's part of it. But so that's something maybe to look into. But if it's sort of relatively consistent over time, the way that they do these calculations, on a, maybe like on a per square foot basis, I'm not sure exactly how they're doing this, but that would still be pretty darn bad in my opinion, because that's people are losing wealth. They can't tap, right, those home equity loans and all the madness that can go on in that area. And a lot of people are not well off, right? So this is going to be, if this continues to, continues, it's going to be a lot more haves and have-nots. I don't think it's good that, that this people don't seem to care that so many people are, the people that are in leadership positions, which is really charitable description, but if you get, I'm just saying that I have a problem with the things are going to be incredible and wonderful. I would still just trade the charts, but I'm just saying I have a problem with these wonderful arguments because so many people seem to be left further and further behind by the so-called economic progress. So whatever the case may be. Anyway, this is concerning too, because look at what's going on between surprises, right? Economic surprises, which is the black line, and then of course the market. So that to me has to be concerning, right? They normally have somewhat better correlation. Something's really, excuse me, something's really amiss here, typically, right? You would expect. So just again, another little factor I think you got to keep in mind. This is another one. This is why I was saying to folks in the pit and elsewhere that you've got to really be careful. You don't typically see, right, this kind of a jam job. So this was a 99th percentile jam job that we saw. You just don't see readings higher than that often. Again, I think we were saying it in terms of like maybe like the seventh or eighth. It looks like maybe on this view, maybe like the ninth or 10th time in 30 something years or 30 plus years. So that relatively rare to be to the extent that we were. And then here's the, once again, right, here's this just loving, loving big tech or loving tech in general, and sort of shunning, I guess, some more traditional stuff in the Russell. So this is, well, remember where they're all concentrated though, and remember what end of year means. So just just keep that in mind. This is all, it is what it is, but I think it just, some of these perspectives are pretty good. This is the kind of percolating under the surface, lurking under the surface stuff, right? That you've got this bailout facility that it's being said that they've been helping to the tune of $500 billion to a sprawling Japanese bank you'd never heard of. So that's what I mean. Like, it doesn't have to be a US thing. It could start somewhere else. It's often started out somewhere else in the banking financial system, and then it just metastasizes and spreads everywhere. Anyway, there's the emergency bank bailout facility, right, where you're supposed to think everything's wonderful, but look what's been going on. It's not at the fever pitch we saw it at earlier this year, when I think you had those regionals and things like that were really in trouble. Technically, it fell apart, getting smashed, but it's creeping up again. So there's a lot out there. That's why I'm going through this. I felt like you all ought to know a lot about this stuff. Here's the seasonality, right? And you could see the darker line is your average year, and you could see what they do right in December and late dec. So again, you're 4 sessions away. That would be what normally happens, right? Right, exactly what happens in most cases. And then I'm going to end on this one, because this is my message. If I can bring one message that I would share, it's this one. The best forecaster of market action is the action of the market itself, right? So all these things we're looking at as concerns or pros and cons, big positives for the market. Right now, you have to just look at it, and I think I agree with Dean Christians here. This, I think the technicals, we've been saying it, the technicals have looked really good to me, really, really good to me. And I think overall, right, I've been saying this too, but I just don't think without a shift, you're going to, and I mean a dynamic news shift, something significant. I don't see why this would get derailed other than maybe there's a hangover to start the year because of what we've done here since late Oct. I can see that, but I don't know what would cause this whole thing to fall apart. I think really the initial rate cut is met with sort of flatness. And so really after that starts to accelerate is when those rate cuts accelerate, that's when things typically start to get roasted. So I wouldn't, that's why I'm saying like if I had to trace something out, sort of draw this in your own mind's eye, I would say, look, there's going to be some weakness there at some point. I think earlier in the year, I think they're going to try to get it back on its feet, get it going again. Everything's going to be wonderful. I think they're going to try to rally into the first rate cut sometime in the late winter, spring, if all holds news without major news, wars, etc. Then I think the trouble could start for them a little bit there. They might be able to recover from maybe like a May, June swoon, mark back up into late July and into Aug, and then you could have another swoon. And then you get to the election, you see what happens. But I do think the news year is going to be dramatic. I do think it's set up for that. There could be a lot of stuff that happens. So I think you're going to need to be on your toes. And so the final tab is the same exact one. It's the same exact reiteration because I've been getting some good feedback from some of our, really good guys, good clients, and people are in the pit that hear Greg and Ryan and I repeat the same mantras over and over again, ridiculous number of times because that's what we again learned the hard way ourselves a long time ago. If you just stick with the market action and you keep all this other stuff sort of categorized and organized in your mind in terms of the risks and potential, then you keep this, I think, balanced sort of open view that allows you to be more flexible. But that's what I would suggest that you really, if you haven't embraced that mindset, I would embrace that. And just if you're someone who's really a diehard bear, just play small until you feel comfortable to the upside and just be a really strong roller and trimmer, right? You don't have to necessarily kill it to the upside if there's more upside, but you could still participate and do very well and just do it in moderation if you're uncomfortable and then see what comes of it. So here's the Mag 7. I'm starting with them on the technicals because you have to realize, right, that these were looking really good, but they have not been able to get through, right? They've not been able to really bust out and get through. Last week, they had their shot. They didn't pull it off. And there are some, you can see over here, right? If you want to just think of this as a momentum, just a momentum situation down here, you kind of have the slightly higher high and lower readings in your oscillators, indicators, and that is negative divergence. So just be on guard for that right now. So that's sort of a flip-flop from last week by me, where I thought they looked really good, but I knew, in a way, I also knew the market was overdone and it might be hard at the same time. And it turned out that it was, so I think the market looked tired and the market looked exhausted. If you look at the individual, I'm going to look at these individual issues right now through the whole thing. And Apple, right? If we look at Apple, this is a little concerning here if it doesn't hold Friday's low. Now, again, markup madness could start and this could be erased very quickly. But if the biggest of the big dogs is struggling, and you can see there's negative divergence here now, it's getting worse from that high. You got to say that's a little bit of an issue. Amazon, excuse me, I like this one. I actually put an idea out over the weekend, which is relatively rare, just to make sure people were ready for it to go if it were going to go, and they came out for it like gangbusters. So I guess we weren't the only ones thinking that way, but it really kind of front loaded all of its gains. Most of its gains for the week were really there in the early stages of the week. But that was, to me, that also looked good. But look, it's up there now. These, by the way, what we've covered so far, these are all still looking good, big picture. I'm not saying there's a crash coming. I'm just saying that there could there could be a pullback after their inability to really go. Meta looks made a new high, right? So we can't really say anything. Again, this looks really good, but at some point, does this the market being overbought, these things sort of dawdling around near overbought status, does that turn into some actual selling? Like I said, maybe there's a new year hangover effect. On the flip side of that, Microsoft to me, right, you can see it's sort of triangulating. You've got this really relatively narrow range. The volatility's dried up, stock volume is dried up. So you're really, this is one to keep an eye on in my book out of these, because they all are obviously, but you could see, right, triangle type behavior where they cause a false breakout, pull it down hard. Remember, false breakouts are good trading opportunities. You just got to 180 yourself. The other side of that would be false break to the downside early in the week, and they try to jam it because that's what they do this time of the year. We already kind of saw that. As usual, I skipped over Google. I have some kind of mental block for that. I don't know why I always try to go in alphabetical order. We liked Google for a while. It sort of tormented us with a lot of UOA, not didn't get the breakout, finally did. So that was good. Right now, though, Google creeping up, but it's not so overbought because look, it's sort of sideways for a while here. Okay. So I just want to cover these because these are worth covering in my book. We did Microsoft Meta. We could jump ahead to, I think, Nvidia and then Tesla. And Tesla was a disappointment to me. I thought it was going to at least print like into the 260s this week, and it didn't. So there you go. Do this for all these years and try pretty hard at it, and you're still not going to get them all. Going to get them all right. But this thing to me, right, this is obviously such a key stock at the moment, key to that sector. You've got this lower high situation here. This couldn't break out. Again, I think the market itself was a very hard place to be where you're so overdone in so many ways. It's really hard, but we'll see if they save the best for last, right? We'll have to see. It's still above the 10-day, the 15-day, the 20-day. So really it hasn't cracked, right? They've managed to hold it even above the 10 in white. In big picture, it looks like it's on the verge. That's the thing about these stocks as a group. They all look like they're on the verge of going again, leading again, but they some little things have cropped up that I think are worth spending time on. Here's the Tesla, and you can see this is the technician's sort of dream where it breaks through big time resistance. It then pulls back after doing so, finds support on the former resistance line or the SMAs or both in this case, and then starts to load up and go, right? That's what everyone kind of likes to see in terms of healthy breakout behavior. I don't, myself included, by the way, but I couldn't put a number on it for you. I couldn't say, well, yeah, when it does this is really great, and it's a lot more reliable than going too far fast and then falling apart. I don't have those numbers, but to me, like, I think there is some truth to that. It does make you feel better, at least as a trader, that it doesn't get super, super, super overbought, and you can sort of get that little sharp pullback and get in and go. But that's primed to go above Thursday's high. Yet, right, if that would also be a false breakout that really it would trap people thinking that Tesla is on its way up. It broke resistance. Let's go, go, go. And you get only because maybe, well, you never know, Tesla news, who knows, or just a combination of the market itself having the hangover, and you fall back down towards the SMAs like the 250 and 200, which would be a quick punishment. So, but overall, I mean, it's still working its way there, but it looks to be on the verge of going. So as a package, they look on the verge of going. Let me try to get it built for us again. Now that we've covered all of those, where am I now? Besides being exhausted and tired, needing a nap already, and it's not even noon. That's the crazy American Christmas for you. NVDA and then TSLA. Okay, so hopefully that does it. And then there you are there. And I think if you kind of look at it, let's see if I can get more of like a 5 or 10 year weekly. And you can just see the cup and handle here. You can just see that. It's if you're willing to not have that perfectly rounded cup, a lot of sticklers are not. I don't care about how rounded. If it generally kind of appears in my mind as a cup and handle, I go with it. And again, I mentioned many times that I think that's a really good pattern. And so that's why, remember though, there's a lot of people are going to see this as not just us, and it's going to be the possibility that something, you could have something fall apart because it's almost too easy, right? Type of a thing. And it's being shared probably a lot out there. So just keep that in mind. But I mean, look, that's an all-time high. This month is a new all-time high, it appears, for this collection of stocks. So yeah, it's not really all-time highs are not something that you should take lightly. Usually when you're making them, there's more to follow, usually, but not always, right? So again, until you're out of this false breakout danger zone, I think you have to just be on extra guard. And then if you start to see that the market continues to maybe have a little bit of a pullback and then just keeps going, then you join in, with more enthusiasm. But here's the weekly look on the SPY. I had a few things there, but you can just see what we're talking about, right? Where you got that corrective action, you get the breakout from there. There was on the daily a kind of a pullback, I believe, I think. But again, you kind of have a cup and handily sort of a look to it, and you're getting close, right? So I don't know what I don't know what headlines, excuse me, would be better for the powers that be than to print new all-time highs on December 29th and say, final session of the year brings all-time highs in the Dow, the S&P 500, and the Nasdaq. I don't know. I mean, what's going to get better than that in this reality? So, excuse me. So, anyway, that's the bigger picture look just on those. Drilling down to the daily that we usually work with, you could see where I've got those arrows, right? And so I would probably just move those forward a little bit if there is going to be a pullback. But clearly that line right there, that blue line that I just highlighted, if you can see it, let me see if I can blow this up a little bit. That blue line is, or formerly blue arrow. I'll move that over to here. So if it does have like a two to 3 day pullback, that's where it would come in at. Let's kind of ballpark that. Looks like it's going to be where down, 1.5%, maybe something like that. So not 467-ish. And then I think from that point on, you'd start thinking about where the 20-day would be, and it's going to be right near there. And that happens a lot. And that's why the 20-day is really good to keep an eye on, right? Because you could get right near there. I mean, it's going to be very close. So maybe 1.5 to 2%. And you would expect that the 20 would hold overall, right? Especially right if this bull story is the real deal. So just keep that in mind. If you're going to get a pullback, if it starts getting worse than that, that's when you probably have to start worrying a lot more, because then I think you could fall apart, and we'd have to probably start looking at some fibs at that point. But that's why I like to chart, a way that I call like iterative charting, where what we do is we whatever comes our way, we start thinking on how things could play out from there, and we just keep making adjustments, and that way we just stick and move with the market action as best we can. Anyway, yeah, there was no daily pullback here. I think the one I had in mind was once it got above the 50 there in gold, it actually kind of pulled back and confirmed, right, that it could hold that support and go. That's what I was probably thinking of when I thought that it did do something. It didn't do it on the resistance line, but it did do it on the 50. So it's been a hell of a run, obviously, right, that you tacked on so much. You went from 409, you might get up to 479. So it's about what, 70 points. So they've been able to put on, I don't know, what does that come to? About a 17 and a half, 18% 2-month tack on. That's a great year. So well done, powers that be. Good, congrats. Let's see here. The Qs, I think the Qs made the new high, right? If we look at these on the daily, Qs made a new high. I think they did. Come on. Yeah, there you go. So there's the new high. If I'm not mistaken, I think, is that the, yeah, I think that is higher than any other high. So there's your cup and handle we talked about, and there's your, new all-time high. You have breakout risk, false breakout risk, but otherwise, right, fighting against this to me, is dangerous. If you're a bear, I mean, I think you better hope that this is a false breakout, because otherwise, right, I think they're gonna try to move this thing up to, I don't know. I think I've got some projections on the S&P, but it's more like anywhere between 49 to 5,200 there. So, it's significantly higher. The diamonds, right? This sort of surprising to me that industrials have been able to, and other things have been able to help this do what it's done and make this kind of new all-time high. And you can just see how strong this move has been. But because of the sharpness, that's again another reason to sort of be ready if they do start pulling back. It could be a quick little sharp one, at the very least. But if we look at it on the daily, right, you can see that this is trying to hold that 10 SMA there in white. But this, to me, in the face of still higher rates that are still higher and haven't come down, to me, is just a remarkable move. But it is what it is, right? And overall, there's a lot of, the other thing I should mention really is that a lot of, with all this money having gone in, I kind of felt like it was something that I was alluding to. With all this money having gone in, there's a lot of people that could be trapped, right? And there's a lot of people that may be overcommitted, and maybe it's a crowded trade at the moment too. And remember, the dumb money's jammed in here. Options probably a lot of new options. People are going bonkers again. Just those are warning signs that you've got to be respectful of in my book. So, not to say that they're always wrong. It's just that there's a history there, right? And you got to be, I think, wary of that. This is interesting. We talked about this week, and this is the 1 year on the IWM, and that's also got the false breakout potential. But if this bull thing is legit, right? If this bull thing is real, this is the good perspective. I think if I can make this, look good, just if this thing gets back on its horse and breaks out of a nearly 2 years worth of consolidation, and really, that's going to have a lot of potential. And that's one reason why I don't think I'm alone, but I think you have to keep your eye on this. If rates keep coming down, it's going to help these guys out a lot, and in theory, at least. And that's going to probably draw a lot of more money to come in here that will see that this is undervalued in some ways, probably fundamentally and technically relative to other things. So there could be a rotation, right, out of incredible winners in tech into some other names here because they're buying the bull market story, right? The only problem that IWM has right now is the overbought situation and the lack of a breather. The gaps thing is starting to not be a big deal because they've been able to keep and hold more than 5 days. And in my book, once it's there, I'm not so concerned about it anymore, the way that I normally would weight it in my thinking prior to it being a 5 days passing. But you can see that, right? I think everybody that can see where we are, right? Short-term overbought really could use a little bit of a pullback, may not get it because this end of the year is typically the ramp. Without a big news dynamic shift, all it could really be would be something like happened last week with the 0 DTEs, and you get this gamma break, etc., or just thin market conditions, and that add to the situation. But otherwise, these guys are going to try to give themselves an A+ for the year and make it as painful as for people who are not participating or are not short, or worse, are short and fighting this. That would be their goal. I don't know if they can pull it off, but I do know the tendency is that they win at this. So just keep that in mind. Let's look at the 10-year, let's look at the dollar, and let's look at the VIX, and then we'll wrap up. And I'll wish everyone a wonderful situation here. But look, the best thing we could say here, oh, you know what? Because I've decided to combine these two videos, we're going to talk a little bit about the sectors. My bad. I'm trying to just get the macro portion done. But look, on the one hand, this thing is a little clearly smoked, right? It's clearly smoked. It became oversold officially, right, at the lows. But at the same time, right, you could say that did this thing is it on the verge of cracking its trend, the uptrend that it's been in? And I would say, excuse me, sorry about that. But I would say, look, there's a strong possibility that you, or at least something worth thinking about that you, if you're like, no, rates are still going to go, and they very well may. I never try to be emphatic about, oh no, this definitely won't happen. But if you just take a line here, we do the best we can with it, because the Thinkorswim just doesn't scale the way I really want it to. But you get the idea, I think, there with that white line that I just added. Let me see if I can boost this up a little bit. I just don't like the way this thing scales. It just, and it's very awkward to make adjustments here. I just, see, now I redid everything and I'm gonna have to redo it again because of the way this thing operates. Boy, is it frustrating. I feel like I should be using my trading view on this, but I'm trying to keep this moving along more quickly. It looks like I just lost my line on top of it. Great. Well done, guys. Anyway, frustrating a little bit here for me because I know this is a super long video, but um, look, the 50s right there on the 50 week, you could see your support line. It's not perfectly drawn, but close enough for what we're doing here. So that's on the verge, and the only good thing about it right now, honestly, is that it's gotten beaten down so much that it's oversold. Now I know we're talking about this like it's actually right, just the rate on the 10-year. It's not really the instrument. So, but I know I'm talking about it like it's the instrument, but I think you still get the idea. Now, as far as the dollar goes, again, weak dollar, usually good for stocks, expensive, pricey dollar, not. And the dollar itself, too, is really getting tamped down. In a way, this is not something I want, but personally, but that's a whole nother matter. But look, again, the dangers of a false breakout, looking good, then they reverse it hard on you. If you overstay your welcome, don't do a quick trim once it popped. Overstay your welcome. Now this thing's like looking as though it's on its way down. You would think that it would probably, again, save for news developments. You would think this probably starts to come into the 150, the 200, this retracement to maybe this retracement matters again. I don't know. But this general area where it has sort of supported before, was resistance before, down a little bit more. So that doesn't look like it's ready at this moment to just start reversing. But again, news can change that, where the dollar becomes big very quickly. That's been my experience anyway. And then VIX, the VIX, right, which I thought at this point, I was a little surprised, kind of felt a little concerned there that the VIX hadn't gotten hit more, right, with this 3-day weekend, holiday weekend, and then a short week, which might be just a few days of real trading, and then they kind of snooze control it, late Thursday and through Friday, like they kind of did this week with Friday's action. We'll see, but that could happen. Anyway, I would think if it does, a telltale sign would be if this thing doesn't get hit again, then somebody's really thinking in the short run there's going to be that hangover effect in January. That would be a little thought that I would share that I've had at times like this before. Now let's look at some of these sectors, because we're doing the one video here this week, because my wife's probably ready to give me some real gruff. I'm guessing she hasn't given me any yet, but in terms of everything, right, you can see the grid of 12 that we usually work with in sector situation. And I just want to point out, right, that there's a key sector, XLK. What better participation are you going to get? Even real estate, right, which has a lot of issues, if you ask me, boom, it's just jammed. The other important sectors, XLF, boom, jammed, new highs. Discretionary, boom, jammed, new highs. Right here, transports, which I've been calling them canary in the coal mine for things falling apart in the market, they have also risen and they're back towards, right, the summer highs. You've got industrials that just made a new high. You've got even materials that are near the high, right? All these things, I mean, we could go on and on and on. So you've gotten tremendous participation. I think clearly the XLE out of all these is your main outlier. So if that starts to catch on fire, right, that's kind of like the Charles Dow type stuff. It's all like it's all firing, and honestly, I'd welcome that and would love to be for my macro and interest rate and reappearance of inflation concerns to be dashed. That would be awesome, I think, for all of us. But I just want to make that point in terms of the sector video that we are combining here, that this, when people are, I was saying that it was the Mag 7 earlier this year only, but then they got a lot of other things participating. I don't see that this as being just only Mag 7 at this point. I don't want to, I don't ever like to really disagree forcefully with people because there's so many ways to look at these things, but I just don't see that at all. So I'm just going to leave it at that. I just don't see that this has been that narrow. It doesn't appear to me to be that narrow. Let me also now look at things related like XHB, right? So let's just look at that on our basic charts. And this is one where, given what's happening there, given where rates still are, the fact that this is doing this is just in a way remarkable to me. But right, in an uptrend, right, when things find support and turn, that's when you're supposed to buy, and that worked, and even in the face of everything. So this is a tremendous example of where I got tripped up coming out of college, thinking, well, this is important, this is important, these things are saying this. There's no way the market's going to be able to, or this sector or the stock's going to be able to weather this storm and keep going, keep getting ready for this reversal. That was in my early days, and that wasn't true. It just the market action the market didn't seem to care about that until more time passed. So a reckoning with reality that can take a lot longer than a lot of people, I think, realize. So I'm just kind of reiterating that. There's the daily. We were looking at the weekly, my bad. So that's just kind of hitting on the XLRE, kind of the tying those two together. Another important sector we look at each week is SMH, and you're just off the all-time highs. If they manage, and I don't know if they will, but they manage to get NVIDIA going, you know what that means. So just keep an eye on NVIDIA, and if they get that thing rolling, they're going to take these highs out, and you're going to be, you're going to have an initial, initial strong pulse out of there. Brief corrective action that's relatively shallow, another surge, another brief pullback, good signs for a strong bull action, take out high, keep going, unless, of course, remember, that's where the time of the year factor and the state of the market comes into my thinking more, that you've got to put it within context. I say it all the time, where am I in the grand scheme? Put this in context. The context would be, yes, but the whole market is on tilt, right? So you might have that hangover that you also have to prepare for. But look, as at this moment, this snapshot in time, this looks good. What else can you really say? What else? Let me think about some of the other things that we cover on sectors that are worth covering. Yeah, let's take a look at XLE more up close, and we'll see what the technicals show there, because you can see that. Right. Look, let's see if I can get a little more detail, because I know this sounds ridiculous to people, but this is one of my least busy layouts because, as I've said many times, I like to check a lot of things, and I got used to looking through all this noise to find what I need just from doing it for so long. But, I just have the OCD. I don't think there's any way around it. So my OCD becomes your pain. I'm sorry about that. But look, improvement under the surface, bottom, a third time go. That's what I'm getting at here, right? You can see that this is not really worsening right here on a lot of our basic classical indicators. Right near the 50, it could break out from. And then you're looking at the 100. Then you're looking at this high here at 80, near 88. If it starts going there and they get the bull thing keeps happening, right? This thing's re-engaging with the market, and that's really a good sign. So that's the last, I think, big kind of Charles Dow-esque thing that's kind of not there to say, here's a problem. Not to say there aren't issues in the financial system under the surface. I don't mean that. I just mean from the superficial sort of high-level technical view, it all would look awesome, which is, again, why the bull trap thing is a possibility, because when you combine that with rates get cut, everyone's in the pool by March. They start cutting rates. Everyone thinks that's great. The reality is, history shows that the market's down a year later by over 10% historically. So there's a lot there. We got that one. Let's take a look at XAU. I know a lot of people are, and I think this is also interesting, now, but that has started to improve clearly, right? And it's getting there. You need to probably, your next thing is, can you close above this high? And to me, when you close above that high, that opens up that territory above. It's sort of like the release point in my mind. It opens up the clearance zone where there's just not so much resistance anymore. So just kind of keep that high in mind there. That is about 131-ish. So, probably maybe got a little toasty here this past week, maybe near there. It was kind of in the probably getting closer on what's the RSI reading that day. It looks like it was 66. So kind of getting up there. So, but remember, you want to, now that it's gotten above this high, you want to see it hold that high. If it doesn't hold that high, then you're concerned and you probably pull back to these SMAs and test those. But overall, that looks good. What I'm going to do though is take a look at GDX. And I mentioned this in the initial PowerPoint commentary. The long-term view is here. And that's not as good of a long-term view as I wanted, but let's make it a little bit better. Anyway, you kind of have this cup and handly thing we've talked about forming. And so again, the potential's there if this thing launches. Uh, it's not as good of a look. I think GLD may show this better than that chart. And it does. Yeah, it actually does. But anyway, there's GLD, and you can see that more clearly. It's really getting up towards the top of the top, right? Where the top of the cup, where the handle meets the cup, whatever you want to say, it's getting there. So just keep, again, I'd say keep that on your radar. I'd keep if they do break the stuff out, I would keep these guys, the juniors, on your radar too. They're maybe going to lag behind initially, but when these things, I've traded this several times, and when the gold and the bigger names really start to fire, there's a lot of catch up that happens here, and you can get in some very reasonably priced dirt cheap volatility, set yourself up for stock replacement, and then get that catch up trade. That's another kind of, here's what I can try to tell you about possibilities in 2024. Let me think if I've got any reminders on this, any reminders that I don't want to overlook. I covered IWM, I covered XLE. Yep. So Mag 7, I don't know. I might be able to grab Mag 7 from here. Nope, there. I might be able to grab it right from here. And so this is another view on the gold. So similar but different, right? I've got a lot. This is more of a daily. I could probably switch this over just to make it a little bit more really readable for everyone. But you can sort of really see that cup and handle here. So is it textbook? No, but you get the idea. So just, again, I definitely would keep my eyes on that. And I think I'm trying to think if there's anything else that I could cover. That I'm not going to go into the nitty gritty of like the housing market or crude and all that. I think the XLE shaping up to want to at least try, but again, news can change that anytime. Anything else I can do here? I might be able to do and see if we get one final thing, because these are so important. I may be able to get us a better view, kind of a better aesthetic view of the Mag 7 on this. And there you go. And so the nice thing about it, looking at it on the weekly, is you can see that you have had this corrective activity on a bigger picture view of the charts, and it's not as bad, right, as you would think in terms of overboughtness. So again, I'm looking to summarize. I would say, look, if they mark out the year really strong, or at least hold here, that's really good. But either way, could create a little bit of a hangover effect in the new year. Maybe after a session or two, you see profit taking at some point, and then everyone starts saying, yeah, it's time to book profits. You get a little bit of a pullback. I think they're, again, aside if news neutral assumptions, if they then from there, I would think they try to get things back on their horse. and start trying to, if we do have the consumer overextending themselves again, which we very may, it's pretty much what happens a lot in this country, then we would have this kind of like story they can sell about how the fourth quarter, which will be reported right in the middle of the first quarter, is really looking good. It's going to become really good, and you want to buy the hype on that in most cases, and then you want to sell into those super bullish reactions if there are to be some. And then that sets you up for that you could then see a little breather. Then you get to the Fed. They probably celebrate leading up. They probably celebrate momentarily thereafter. And then you have to then, I think, start worrying about what comes next because of the tradition, or I should say, the history that's associated with market performance post the start of rate cuts, which we already know, according to Nick Maggiuli, from Ritholtz, or at least was at Ritholtz at the time, that's when it's not so wonderful for the following year. So you just got to be ready for that. So that's my kind of big picture view. If we don't do that sort of market rebellion look forward, I thought I would combine that into here to try to do the best I could for everybody under the holiday circumstances. There's more I'd like to share, but again, trying to keep everything reasonable. So on that note, I'm going to wish everyone a wonderful and Merry Christmas and Christmas Eve and Christmas season. If you celebrate Christmas, if you celebrate other holidays, that's your tradition. I want to wish you a wonderful time and safe time for that as well. And I wish everyone a happy new year. I do hope that you receive benefit from Market Rebellion services this year. We try to put as much as we can into them with our resources that we have, and we want to see, that's the whole point of setting these up, is to try to help folks to learn this stuff and to be able to really open up a much brighter future for themselves through options and through the opportunities in the market. And I see the progress of certain people that have really applied themselves, and it's really very rewarding to see that people struggle and then they make the adjustment. They just start really worrying about, well, what's the market telling me? What's the price action? Where am I? A lot of these things, again, that I learned the hard way, they turn the corner and they start doing really well for themselves. And that's the good news about, what guys like Bill Johnson can teach people and things like that at Market Rebellion. But that would be my really final note. I do hope you benefited from this. I do hope something I shared with you this week helps you out this week or helps you out in the new year. And let's hope we have a really great trading year at the very least. Hopefully we'll have a great economic year and turnaround, and we'll also have a great trading year as a result. That would be the ideal. So on that note, everyone, again, stay safe, enjoy the holiday time with your family, and thanks again for tuning in. And I will see you all during this holiday, post-holiday week of action. Thank you.